Welcome back. It's now a 1,400-point fall on the mid-cap index. When we started the show at 11 o'clock, the mid-cap index was down 1,000 points. And as you can see, the slide continues. It's getting very, very ugly. The cuts are deep. PCBL, a stock that we spoke about, 7% gone. RVNL, one of the big movers over the last couple of days, that's lost close to about 7%. Kalyan Jewellers has been weak this month itself. Since the beginning of the year, the stock is down nearly 24%. Adani Wilmar is another stock which is under pressure. Oil marketing companies are reeling with weakness on the back of the rise in crude prices. So HPCL, IOC are down 5 to 6%. Swiggy, another big wealth creator, ever since its short listing, it's been on the last street not for a long time, but Swiggy has corrected close to about 5%. MobiKwik, Paytm, some of these new age tech companies too are the casualties in today's broader market fall and the pain that we're seeing. Rakshit Ranjan from Marcellus Investment Managers is now with us on the show. Rakshit, it's been persistent weakness now for nearly 3 to 4 months. What are your thoughts on it, and what has been the approach in this fall that we've seen?
Good morning. Thanks for having me on your show. So yes, you're right. There's a very tough economic environment out there. Although corporate balance sheets in general are in a good position compared to, say, a decade ago when we had an economic downturn, but this time household balance sheets are under stress. Government spending has moderated significantly. Currency, fiscal deficit position, etc. It's all flashing weakness signs on several parameters. What we are doing to the portfolio in the last 12 months, we've added exposure to several areas where some of these economic factors are not going to play a role. So, for instance, export-oriented companies, IT services, I would say healthcare, pharma, hospitals, diagnostics. These are some of the areas where I think you can call them macro-oriented safe haven in the current environment. But otherwise, if you've got companies with market share gains and prudent and good capital allocation decisions to grow earnings, only then can you expect some resilience in the share prices. Without earnings growth, it's going to be very difficult because the macro is against most businesses.
But do you expect the domestic macro to remain subdued through the course of this year, or are you anticipating a turn? At what point should one start looking at the domestic facing economy stocks?
No, that's a very, very big question. Signs of a turn in the macro environment aren't visible yet. There is a possibility that a couple of years down the line, there might be some resilience in certain parts of the economy, particularly maybe staples and all. The base effect might become a little favorable for certain areas, but I think overall, I don't see government spending, job situation, and hence some of those parameters recovering anytime in the next couple of months. So earnings growth more from capital allocation and market share gains, I would say, would be the best bet in areas which are exposed to macro headwinds.
Sure. So earnings growth is something that is a key factor that you're keeping an eye out on this year. What is the earnings growth that one could actually anticipate during this year? Any number that you all have calculated as of now?
Yeah, so not so much for the broader market, but let me give you some sense. So last 2 quarters or first half of FY25, the reported first half, our consistent compounders portfolio saw a blended average earnings growth of 17% versus the market's pretty much flat, if I'm not wrong, flat to maybe positive 1 or 2%. So that kind of a difference in earnings growth can give you resilience over the next, say, 12 to 24 months. And this is largely, again, because the companies in our portfolio. So let's take some examples. So Divi's Laboratories, Trent, these are some of the larger allocations. Their earnings growth rates have been pretty healthy, margins expanding. Although in some cases, like say Trent, the macro is against on the consumption side, but the growth rate of the business continues to be healthy. So that's the example that I was giving about earnings growth. For the broader market, I don't think we should expect double-digit earnings growth anytime soon. given the external environment, at best, they should be a mid-single digit expectation for the broader market in the next, say, 12 months.
Right. Rakshit, what also I want to understand that, given that we've seen a bit of a fall coming in the market, actually not a bit, sharp fall coming in the markets in the recent time, anything that you're looking to add now, is there anything interesting coming in that one could watch out for in the consistent compounder portfolio?
There are several businesses, I would say, which had gotten re-rated up very significantly in some of the areas of the broader stock market that I talked about, but we avoided them. So there are some of the healthcare-oriented companies, for instance, which had skyrocketed up on valuations. In an environment like this, those companies correcting is an opportunity that we'll be looking out for. Also, in a portfolio where there's more uncorrelated exposures across stocks, rebalancing becomes a massive opportunity every time there's a market dislocation, because there'll be some parts of your portfolio which might correct a lot more than others. And these opportunities add a few basis points to the long-term compounding of a portfolio like this. So looking forward to rebalancing and some areas where valuations have corrected or will correct in a meaningful way to make them attractive for us to buy.
So for those who aren't, who aren't tracking the consistent compounders or all the Marcellus portfolios, can you tell us some of the recent additions in IT, pharma, healthcare, diagnostics? And is there still value? For instance, IT has seen such a fantastic run-up in the last 6 months, despite EPS downgrade. So is the best priced in at these levels?
Well, again, IT has a very broad spectrum of valuations at the moment. The stock that we've added in our portfolio is HCL Tech, because we see HCL Tech being better positioned both compared to say a TCS or an Infosys on fundamentals, as well as better position compared to some of the mid-tier IT companies on valuations. So that's one addition there. So you have to be selective. It's not that all companies will grow earnings and all companies are equally attractive on valuations. But yes, companies where there is more relevant focus from a future IT services growth perspective in terms of the overall portfolio, and these trends are not something that, let's say, a Gen AI or any tech disruption can actually take away or dilute. I think those are the areas where we've added. In healthcare, about a year ago, a little less than that, we added Narayana Hrudayalaya, which I think over the next 2-3 years should see a significant uptick in the fundamentals momentum. So those are some of the names over the last 6 to 12 months.
Do you see value in HCL Tech at these levels after the run-up from 1,600, 1,500 to nearly 2,000?
Yeah, I think HCL Tech, we see beating expectations, both its guidance as well as broader stock market expectations in the next 6 to 12 months. We also see HCL Tech sort of undergo an acceleration on a relative basis compared to several other larger tech companies in the Indian IT services space, and hence from a timing perspective to add, yes, this is a far better proposition compared to some of the others.
Okay, Rakshit, thank you so much for joining in with us and giving us your view there. But on that note, we're going to slip into a very short break. Viewers, don't go anywhere. We'll be back with more updates after the break.